Hello, this is Rich Canlione from CME Group Trading Floor. Today's segment is addressing the fiscal cliff or falling off. The break that we've been seeing in the last several days, not necessarily about the economic releases, because if we examine what we've seen in the economic releases, Michigan confidence number better than survey, 84.9. Jobless claims better than survey, 355,000. Trade balance better than survey, negative 41 billion. And back to the previous Friday, the mother of all numbers, the non-farm payroll, previous Friday was better, a lot better than expected, 171,000. Even if you examine the economic releases overseas, particularly in China, which has been the perception of a slowdown that could affect the United States. Take a look at the China numbers most recently. Better. Industrial production, better, 9.6. Retail sales, better, 14.5. So what's the catalyst on the break? Obviously, we've had a 6% decline in less than a month. We've had a 4% decline since the election. So conventional wisdom at this point would suggest that what's in the forefront of the marketplace is the fiscal cliff. Whether we're going to address it by partisanship or is it going to be an impasse and particularly perhaps lead to a downgrade in the U.S. debt scenario. Neither side wants that. The Democrats don't want it. The Republicans don't want it, of course. So what's the play? The play is when you take a look at what we've done, based on that minus 6% and minus 4%, the 50-day moving average comes in at 1433. Took that out without a problem. A lot of volume there, in fact. The 100-day moving average, 1403. A lot of volume there as well. Interestingly enough, we stopped there for a while and actually had a double bottom there on a technical basis. If you take a look at it, October 25th and October 26th, we traded down with hard volume, 1405 low, 1403 low, and bounced significantly. That would be our target objective. The 200-day moving average, we bounced just off of that. These are cash levels, mind you. The 200-day moving average, we bounced just through that the other day, 1380. I would suspect that we reclaimed that today. And interestingly enough, you have the coordinated effort on the bond side as well, because obviously we've seen the risk on trade start to move into risk off. And I think you have a lot of capital flows on the European side that think that this impasse is not going to be resolved. We've moved in the bond side just to take a look at it. 146.04 double bottom low on the 18th of October, 146.01 on the 25th of October. Interestingly enough, that was just through the 3% level, 302. So we're locked in that range on the bond side in terms of yield. Today we've traded 275 yield, and that comes at 152.08. Those are the areas that the market is looking at. Is U.S. GDP growth going to be relative to 3% or going to be relative to 2.75%? I think we base out at the 2.75%, which means that the 152 and change level in the bond should probably be a significant turning point and help the SPOOs recover a little bit and the U.S. equity market start to gain some footage and perhaps gain some traction. Play those moving averages wisely. This is Rich Canlione from CME Group Trading Floor signing off. Thank you.